Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
And Victoria Fernandez of Crossmark warning against chasing this market. She writes, "We have seen this story before. Breadth deterioration coupled with bullish sentiment can lead to 5 to 10% pullbacks, and we wouldn't be surprised if the story repeated itself here." Victoria joins us now for more. Victoria, welcome. I'm going to kick things off with the same question that I asked George Concalves about an hour ago. Have you ever seen a freak out like this one over a 2 to 3% pullback on the S&P 500?
Yeah, I mean, yes, we have seen these pullbacks before, and it was what you were just talking about. When we have that breadth deterioration in this market, when you have this internal weakness kind of bubbling under the surface, but at the same time, you have this, for lack of a better word, you have this exuberance, you have this sentiment that is extremely bullish. At some point, those two worlds start to collide, and you see this pullback. But look, Jonathan, we are still not that far below all-time highs, really, when we look at the markets as a whole. So I still think there's probably some room to see more pullback, especially when you're seeing small caps down as much as they are. We know the tech stocks kind of led this rally. We see them leading the pullback we're having here. But I do think some of the internal weakness is driving this. And the fact that the government shutdown is now over, I think investors are starting to look and go, wait a minute, we've been ignoring some of these facts that have been out here, some of these warning signs. Now they're starting to pay attention to it. And we're getting a little bit of a consolidation of a correction here.
This is going to sound slightly cliche, but I'm going to run with it. Just how strong are the hands in this market right now, Victoria? I was listening to Amy Wu Silverman of RBC earlier on this morning. She tuned into Bloomberg Radio and she phoned in and she said something like, "I would describe people at the moment as fully invested bears." How fragile has the buying actually been?
I think that's a great description of where a lot of investors are. It's where a lot of our clients, I think, feel like they are, because we tell them you want to be invested in this market. The pull down that we've seen so far has not changed the trends. The trends are still higher. Until we see the trends change, we see negative relative performance coming out of some of these leadership sectors, and staples start to perform a lot better, then I think you continue to see the market, although it will churn, you will continue to see it move higher. And that's why you want to be invested in the market. But there are these warning signals. We haven't been getting the data. We're about to get it. What is it going to tell us? Is it going to say we're weaker than what we thought some of the private data was actually telling us? If so, then yes, you will continue to have some spaces where you want to put some defensive components in your portfolio. So it does make sense. It is fully invested, but a little bit of a bearish outlook.
Victoria, just to build on what John was asking about, it does seem like institutional investors are fully invested, especially if they missed out on the rally earlier this year. It does seem, though, like there is retail selling. And when you take a look at some of the high momentum sides of the market, that's what's led the drawdown. It raises this question. Earlier this year, retail and buying actually led to the upside, and investors chased that. Is this going to be the reverse of that? Retail selling, and then eventually institutions chasing that as well? Or are they stepping in to actually pick this up?
Yeah, unfortunately, I think you do see a lot of the retail investors chasing that market. And like you said, the reverse right now. Institutional investors tend to take a little bit of a longer term approach. And so they are slower to move on some of these changes. They look and say, what are we looking at 3, 6, 9, 12 months out? Retail investors tend to be a little bit more emotional investors. And so you see things change more quickly and more turnover in some of those portfolios. We have said all along, don't chase this market. Let it come to you. There's going to be an opportunity here because of the weakness that we saw in breadth and internally, that the market's going to come to you. And that's what it's doing right now. So I would actually take this as an opportunity to add to some of the names that you've liked, some of the sectors that you're starting to see troughs and see uptrends. We've talked about them before. You look at healthcare, you look at the big banks, you look at some of the materials components and the metals that are there, and even energy. We saw about 40% of the S&P energy equity sector actually make 3-month highs earlier this week. So I think there's some places you can play. Institutional investors will start stepping into that, but retail investors tend to be a little bit more emotional and move with what they're seeing in the headlines.
You didn't mention tech, Victoria, and I do think that we have to focus on that, given the fact that not only has the tone shifted, but there's been a shift in the fundamentals of some of these companies. Not that they're not earning tons of money, but it does seem like the debt issuance of the past few months has really caused some concern. You are seeing bond markets start to push back. You're seeing concessions in some of the new issue market. You are seeing some bonds lose a ton of value, particularly from Oracle. I'm just wondering if this is a warning shot to you that there has been a material shift in the tech sector and greater risk going forward.
It's definitely a warning signal, Lisa. We watch spreads very closely in the bond market. They are a warning signal, that canary in the coal mine to tell you what's happening. And we've seen the widening over the last month and even over the last quarter. Year to date, we're about equal at this point in time. We had been extremely tight. We've seen spreads widen out. And yes, when it comes to tech, you're seeing large issuance come out. And it's been a question for a while. How are a lot of these companies going to pay for what they're saying they're going to do? And how is that going to affect free cash flow? How is that going to affect their debt ratios? And we're seeing some of that come to fruition now. We're seeing some concerns about what that means longer term, especially if we're not getting the revenue generation that a lot of these companies say they're going to. So definitely something to watch and to be careful on when you're looking at the debt market.
These companies, Victoria, seem absolutely determined to spend. They've said that repeatedly. They are determined not to underinvest, and they don't mind taking the risk of over-investing. Do you really see this market in a position at the moment, at least, to inflict discipline on those hyperscalers who are absolutely determined to spend hundreds of billions of dollars on this effort?
Yeah, discipline is an interesting word, Jonathan. I'm not sure that they are. These investors right now look at these companies and they believe what they're telling them. They're saying, okay, even though we saw free cash flow take NVIDIA out of the equation down almost 20% year over year for a lot of these companies, and now we're seeing debt issuance move higher, investors still say they're going to be able to do what they're doing. You heard Lisa Su this week talk about 80% revenues from data centers for the next 3 to 5 years, year over year. That's a lot of positivity coming from these companies, but yet at the same time, we're hearing builders can't deliver on data centers. There's not enough energy and power for some of these data centers. So I would be a little more skeptical than maybe the average investor is. But, I'm a bond girl at heart, so that makes sense that I would be a little more cautious. But I do think for now, they are taking these companies at their word because their earnings are supporting it. The minute we don't see earnings supportive, that's when I think you'll see it all flip.
Victoria, so how are you handling this? Are you selling tech stocks and selling the bonds as well? Are you buying the stocks, selling the credit? How are you playing it?
Yeah, so we're trimming on some of our big tech names, but also we want to stay within, we have parameters within the benchmark of where we need to be on these. And because there's such strong holdings in the benchmark, we can't just eliminate these holdings completely. You have to have exposure to them. But we are taking the opportunity to put it to work in other areas, both on the equity side and on debt. And looking at that debt, like 7 to 10 years out, we're starting to see the yield curve steepen. That 2 to 30 spread was like sub 100, and now we're about 115. So we're starting to steepen a little bit. It's good for financials. That's our main area of where we're looking, but we're also looking at healthcare, buying some bonds and some equity there. And then, like I said, looking at materials a little bit as well. I think those areas on both sides of the equation you can have in your portfolio.
Stay with us. More Bloomberg surveillance coming up after this. Official economic data set to return after the record-long government shutdown delayed releases for more than a month. Joining us now, the former BLS Commissioner, Bill Beach. Bill, welcome back to the programme. Can you give us some insight into how the BLS will be operating at the moment after a month-plus-long government shutdown? What the first order of business actually is?
Well, I think they turned the data systems on yesterday to sort of end that data desert that you just referred to. And so hopefully everything rebooted well. That's always a question. And then they have to ask about the field staff, how many people are coming back to work. Some of those people probably took early retirement or retirement. It's kind of an older staff anyway. We might want to talk about the CPI. But back to the jobs report that Dr. Hassett mentioned, yeah, it is true. The jobs number, which is acquired from firms through an electronic survey. Now BLS will prompt those firms to send their survey in electronically to Chicago or Fort Walton Beach, where those forms are collected, and we will probably have a jobs number for October. But the household survey, which is collected largely by calling people on the telephone and asking them a series of questions, quite a lot of questions. We may never have those data, and that includes not only the unemployment rate, but all of the breakout by race, by region, labor force participation, all those things that are really important for policymakers to follow. I'm also concerned about the CPI, but I think on the labor side, that'll be the biggest hole. I do expect the jobs report to come out for September, which was fully collected, but not quite written up yet. I expect that next week. I think they're right about that.
Well, you mentioned inflation a few times. Just describe the CPI process, the data collection, how that survey's put together, and why it's so difficult to produce that number.
So the CPI is collected from the first of the month to the end of the month. They put as many working days in there as possible. And it's largely collected, I'd say about 70% of all of the observations or goods, services, are collected by people going into stores. These are BLS employees, and literally going down the aisles and marking down the price and seeing how many, potato chips are in the bag. So it's a labor-intensive thing. Now we're starting that process probably next Monday. That only gives us 2 weeks to collect 4 weeks of data. Now, it is true that a lot of that data comes in electronically. The housing stuff, the gasoline, automobile prices, those are electronically produced data from private sources. So 30%, fine, no problem. But you can't have a CPI with only 30% of the data. So I'm worried about the CPI. I'm worried about the quality of the October CPI. So that's an issue, and we'll see how that works. The November numbers are also at risk because we're going to be collecting those November numbers as well as collecting as many of the data on the October side as we possibly can. That's going to be really dicey, but I think the staff is probably up to it. So let me just say, bottom line, no unemployment rate, no labor force data that shows the demographics, and I think people should be concerned about the CPI. The PPI is collected largely electronically, and of course the import-export indexes are entirely collected from administrative data from the Commerce Department.
Bill, just quickly here, how much are you seeing the reduction in staff for the Bureau of Labor Statistics just generally presenting a problem in both ramping up but also going forward presenting the same kind of accurate data?
Well, at the beginning of the shutdown, we had a really firm number. It was about 1 out of every 5 employees at BLS had quit. But there are 2 areas of really great concern. First off, the field, and I've mentioned that several times. So many of our data from the Employment Cost Index, which is field collected, the CPI, the household survey that does the unemployment rate, these are it's labor intensive. So you have to be really concerned for the 1,000 people basically who work in the field. We don't know how many of those people are coming back to work, honestly. They're largely an older staff, and that means they may have choices in whether they work or not work. And then the other area that I'm very concerned about is the senior leadership of BLS, about 31 positions that are absolutely crucial. And about 13 of those we think are now vacant. That's the largest vacancy rate ever. And so this is expert knowledge that just can't be replaced quickly by going out to Indeed.com and finding some good resume. Those 2 areas I'm very concerned about.
Stay with us. More Bloomberg surveillance coming up after this. Wall Street watching for fresh trade deals from the White House. The Trump administration announcing new framework agreements with Latin American countries as talks continue with China. The former White House senior trade advisor Kellyanne Shaw writing, "One thing is clear, despite the shutdown, USTR has been extremely busy negotiating." Kellyanne joins us now for more. Kellyanne, welcome back. We've been tracking this together since it started back in early April. In fact, since the election took place more than 12 months ago. Are you seeing this administration and White House start to change course a little bit?
Yeah, good morning. Thanks so much for having me back on. I see directionally the White House continuing the strategy that it started with, which is we are going to impose these very high tariff rates and then negotiate with trading partners to try to land them at a place that's a bit more reasonable. And so they're continuing to do so, notwithstanding the White House's concern, which is clearly focused on the issue of affordability, consumer confidence, how much you're paying at the grocery store. Now, on top of this, on top of those 4 deals that were announced, plus we had South Korea, that framework which was released last night, a potential upcoming deal with Switzerland, an interim deal potentially with Brazil. You're seeing the White House tease a more significant tariff relief package, which would really hit Americans at the grocery store. Now, this would be a departure from where they've been going, but I do think directionally all along they've anticipated that they would need to course correct, that there would be recalibrations where there had been overcorrections. So I think we're starting to see the first part of this.
There's some contradictory messaging here. You're well aware of that. On the one hand, you're saying that tariffs don't lead to higher prices. On the other hand, you're saying we need to do more on affordability. We're going to drop tariffs. How do you massage the messaging?
Yeah, there was always a little bit of dissonance between these two messages. And this was always the White House's case to make to the American people, that if we impose an average 15 to 20% tariff on all goods coming from all countries, that's not going to lead to higher prices at the grocery store. It's not going to make your vacations more expensive. I think the American people have always been a little bit skeptical of this argument. And this is something the White House is going to have to continue to message moving forward. Now, that said, what they'll point to is the fact that we impose hundreds of billions of dollars of tariffs in Trump 1.0, and that did not lead to inflation. And if you look at countries like India or South Korea, which naturally have very high tariff rates, they're not concerned about that leading to inflation on a day-to-day basis. So why would that pattern hold in the United States? But I do think voters are not quite there yet, and this is something the White House is going to have to navigate.
Kellyanne, how much is this argument a liability for the White House when it comes to the Supreme Court case? The idea that they're arguing that this is a national security issue while also talking about reducing tariffs for cost of living concerns.
Well, I think we've got a bunch of different types of tariffs, some of which are being challenged right now at the Supreme Court, others which aren't. And we've always had carve-outs since the beginning of certain product categories like your iPhone, your laptops, some of the pharmaceutical products and aircraft and airplane parts have always had different tariff treatment. So shifting some of that around or targeting certain food products, I don't really think is going to make that much of a difference in terms of how the Supreme Court is looking at this.
Do you think, though, that, Kellyanne, when you talk to some of your clients, there is a feeling that maybe we've seen the peak in terms of the tit-for-tat trade war type of behavior, just simply because the cost of living concerns are starting to trump the concern about national security and the concern about getting leverage internationally?
Well, I think regardless of how voters are viewing cost of living, that we effectively had reached sort of the peak of this trade war to begin with. The president was always going to come out swinging at the beginning to make this huge move to try to negotiate with every country on earth and then land the plane at a lower rate. And that's what we saw him do in August. I think we're beginning to see more and more tariff reductions as part of these deals being negotiated. But I wasn't expecting these huge swings moving forward. I think this is effectively where the president wants to land things and have the tariff rate be on average at the end of his 4 years. Now, I do think that consumer confidence and affordability is a significant issue for the White House, which is why you're seeing them take this head on, as opposed to the prior messaging, which was more about don't worry, the economy's doing great, kind of ignore how you feel. They're not there now. They're head on addressing this. And I think that these recalibrations on tariffs are a reflection of that.
Stay with us. More Bloomberg surveillance coming up after this. Equities pulling back as traders digest hawkish signals from the Federal Reserve. Darrell Cronk of Wells Fargo highlighting the 3 I's that matter: inflation, interest rates, and illiquidity. Writing the recent sell-off is more about positioning in sentiment extremes and weak hands than a change to underlying fundamentals. Darrell joins us now for more. Darrell, good morning.
Good morning, John.
Just build on that a little bit.
Okay.
The fundamentals are strong, are they?
The fundamentals are still strong. I don't think that there's a lot of debate about that. What I would say, the 2 things maybe in yesterday's sell-off that people missed, right? Number one, you had all the Fed speakers out being hawkish, right? So for a moment in time, Fed funds futures for a December cut dipped below 50%, right? The prior day, just to put that in reference, they were at 69%. A month prior to that, they were 95%, right? So that's a pretty big move. That's the spark that lit this thing yesterday afternoon that we started the sell-off, right? What I found was interesting yesterday was, obviously decent breadth on the equity sell-off, but if you looked at yesterday, Treasuries were negative, Bitcoin was negative, gold was negative, the dollar was negative, right, which is everything. So going back to the point about weak hands and stuff, when positioning and sentiment gets out over their skis or offsides, and people have to cover margin calls and other things, you sell what you can, not what you want, right? And so you're forced to sell strong assets, treasuries, right, gold, things that you would normally hang on to meet some of those extremes in markets. So I think that's what you saw yesterday.
Everything that's done well in the last year or so, year to date, did poorly yesterday. Got that. The equity market,
yes.
Is that a stronger story to get hold of? When you look at the equity market right now, and people are talking about 5 to 10% pullbacks, is that a pullback people ultimately want to buy, or a pullback people run away from?
So we have a lot of conviction around this. We've been, like a lot of people, waiting for that kind of intra-bull equity correction. 5-10%, you usually get 2 a year, 10%, 1 a year in a calendar year. We think this is absolutely viable, right? We like the fundamentals going out into 2026. So if you get a 5, 7, 10% pullback, I would be using it as an opportunistic way to add capital in. Now, what we did do is we downgraded technology on October 30th from favorable back to neutral. Neutral still a sizable weighting, obviously, in a portfolio. Ironically, the NASDAQ hit its high on October 29th, so sometimes it's better to be lucky than good, right, on those type of things. But where we would put capital is in places like financials, industrials, utilities, places where you're getting some of the benefit of the horizontal expansion of AI without having to buy the valuations of the tech.
Okay, I love this. You're the second person this morning who said, yes, buy the dip, not in tech, but in everything else. Buy the dip in financials, buy the dip in healthcare. At what point are we hearing an increasing aversion to buying tech at these valuations, even in a 5 to 10% drawdown, just simply because the structure of some of these companies has changed?
Yeah, I think it's a good point, Lisa. I mean, the point I made about being neutral, right, with the market cap weightings of the index, you still have to have a meaningful position, obviously, in technology. But let's just admit, things got out a little bit over their skis here. They got a little white hot. We saw the same thing happen in mid-October. Remember, the catalyst at that point was when President Trump came out and said he was going to put 100% tariffs on China and that he and Xi weren't going to meet. And all of a sudden, the VIX spikes to 28, right? This morning, we're at 22, right? So that kind of what I'd call sticky volatility that's been with us for the last 30 to 45 days, I think is emblematic of what's happening as we transition in this tech world. To us, just valuations just got to extremes through the summer months and the early fall, and we just said, time to take some profit, right? Pull that back. I don't think you abandon tech by any means, but we find better risk-reward trade-off in places like financials, industrials, and utilities.
Does the move that we're seeing this morning in bonds in particular make you like treasuries once again as a hedge? And I'm talking about long-term treasuries.
Yes. I mean, I think you can still buy treasuries here. What people forget is if you look at the Bloomberg, U.S. Bond aggregate, it's up 7.5% year to date, right? I mean, we haven't had positive bond returns for probably 4 years post-pandemic, right? It's finally accretive again to portfolios, right? And so I think you can still use those bonds as a traditional way to play that sector, right? What people also forget is U.S. households own $61 trillion worth of U.S. equities, right? So if you do get that 10% correction, it's meaningful. In fact, if you do the math, it means probably about 0.75% to 1% of GDP that it can shave off if you get a 10% correction, or vice versa, can be additive. So part of the economic growth story has just been the wealth effect of what's happening if you just simply do the math.
How supportive is tariff revenue for this bond market? And if it started to go away or was spent elsewhere, what would it mean for the Treasury market?
It would put upward pressure, no doubt, on Treasury yields, particularly the long side of the
developing?
curve.
Is that happening right now?
Maybe not quite yet. I mean, obviously concerns about IEEPA, but to me, John, the tariff story is not about whether tariffs will be applied, it's how they'll be applied, right? Because if they're not done by IEEPA, they'll be done by Section 122, Section 301, Section 232. It'll take longer to do.
They'll keep raising the money, right?
They'll keep raising the money.
And are they going to keep spending it too? Because we've heard about $2,000 rebate checks this week, and it doesn't feel like that story's losing steam.
Yeah, if you take what they've raised already and just projected tariffs and freeze them at this moment, it's about $410 billion, right? That's almost 20 to 25% of the $1.8 trillion budget deficit, right? So it's meaningful to apply back, against that if you can do it. If for some reason you're going to refund all that money back to whence it came, guess what happens to corporate margins and earnings, right? Because all that money was pulled in. If it goes back to the companies where it came from, all of a sudden it's a monumental lift in margins and earnings.
These are all potential negatives for the bond market, potentially for the treasury market, the credit market supporting massive AI spend now as well. So the bigger question, I think, across treasuries and credit, will treasuries and credit continue to support the big dreams of the equity market, given how it's priced at the moment going into a new year?
So let me put it this way. Our year-end 2026 target for interest rates on the 10-year and the 30-year are in the 4.25 to 4.50 kind of range, right? So higher from today's levels, right? Probably the highest conviction that we have in the treasury markets right now is the curve steepener. We still think no matter how you play it, the curve has to steepen, whether that's short-term rates coming down and long-term rates staying somewhat stable, or long-term rates going up, which is your story, right, about concerns about fiscal, concerns about tariff.
Someone asked this story. I'm just articulating it for them, of course. Darrell, carry on, please.
No, that's right. I mean, but I think the right normal level for long-term treasury yields, right, are in that 4.25 to 4.50. Remember, the long side of the treasury curve is a term premium, a growth premium, and an inflation premium, right? And growth premiums and inflation premiums have been coming down. Term premiums have actually also been coming down lately, but we think we'll expand it next year.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.